Welcome back to the Dividend Diplomats YouTube channel. You got your boys, Lanny and Bert. We are the Dividend Diplomats. That's right, you've heard us. You hear us coming loud and clear. You know what? Today we're going to talk about a stock that has recently caught my eye because it is down 36% year to date. We're going to run it through the screener. We're going to compare it to two other competitors in its industry. And quite frankly, we are going to reach one of the more shocking conclusions of one of our dividend stock analyses in this video today.
Smash that subscribe button, guys. Come on, give your boys here a nice thumbs up on today's video. Here to release on June 8th, guys. And yeah, as Bert said, we've got a dividend stock that's really in trouble as consumer debt is increasing. Times may be getting tougher. And usually there's a few stores that people go to when times are tough. But even the stores that people go to when times are tough are going through tough times as well. It's almost like a double-edged sword here. So what is going on in this industry with this stock down over 36%? Market cap is over 34 billion as well.
Yeah, this one's going to be a fun one because the story is, as you said, Lanny, what is going on with the consumer debt? Over the last 3 weeks, retail has just been getting hammered as warning signs for a potential recession.
Just like Bert when he drinks 3 natty daddies.
Yeah, I mean, yeah, Natty, that would do it. And those are terrible. So I don't even think people are buying those right now. Because
Bert's like, I'll see you on Natter Day.
Yeah, gross. We're not bringing back that challenge again for all of you that remember that. That was just terrible. Nope,
No.
nope. If you say it, Lanny, I'm going to edit it out so all the viewers won't even see it. So, all right. But okay. So what's going on? Consumer debt's climbing. It's over $1 trillion total for credit cards. People's budgets are hurting. There's nothing way around it. The impact of inflation is being felt as the cost of goods are climbing everywhere. Stores are raising prices and just hitting the consumer's hard. That's why I thought it would be interesting when I saw this stock was down 36% because it's in an industry, it's in a specific industry within retail that you would expect consumers to flock to when times are tough. Because we're going to be looking at the dollar store industry in particular. The company we're talking about is Dollar General, ticker symbol DG.
Not DPG, not talking dog pound gangster, not DG as in Darius Garland. We're talking about Dollar General, which, there's a lot of news articles out there that have said even Dollar General has hiked its food prices more than even Walmart and Kroger from a few analysts out there. So Dollar General isn't the cheapest place to buy goods.
Which is ironic, right? Which is ironic because you would think more people are going to Dollar General right now. That is crazy.
Right. And I mean, it's very interesting that them and their best friends of Dollar Tree and Big Lots are just getting, the Rocky Balboa, can they last 12 rounds here?
Yeah, and we brought in the two other comparables when we're going to run them through this screener too, because those are kind of the two other big players in the niche value sector with Dollar Tree, which was, Dollar Tree and Family Dollar that merged in 2015, and just Big Lots, which is a little bit more expensive, a little more specialized, but they are known for their value. So I really wanted to focus here on the value sector of what is supposedly the cheaper options for all of the consumers.
But, when times are tough, people usually go to these stores. You can walk in there with a few dollars and walk out with a few things. And that's kind of the intrigue about these stores is that, at Walmart, Target, all that you name it, you have to usually spend more, even though you might be getting more for your buck. The fact that you can buy a few items in, very small packaging, et cetera, is why Dollar General shines. If you just need that one small, 12-ounce jar of peanut butter or that one sleeve of crackers, Dollar General has your back.
Yeah, I mean, that's what, $3 at Target, all that good stuff. So you're absolutely right, Lanny. So let's go through some of their recent earnings release, which is really what kicked this off and caused the company to plummet over the last few weeks. Even though net sales rose 6.8% and same-store sales increased 1.6% during the quarter, the same-store sales missed the expectations, not by a small amount. It missed the 3.8% expectation. So it was 2.2% under. So sales are starting to decline. Gross profit as a percentage of sales. So you can see how much is the inventory costing as a part of that compared to sales was pretty consistent. It was 31.6% versus 31.3% a year ago. So that kind of corroborates exactly what Lanny was talking about earlier with the food prices rising. They're raising the prices much higher so they can maintain that gross margin, but at the risk of the jeopardy of the sales that are going on, because you're seeing the slight decrease in the same store sales. So that's the double-edged sword that we keep talking about here for Dollar General.
No, exactly. And I mean, guys, if you're not familiar with it by now, we're going to run them through the Dividend Diplomat stock screener as well. We're going to look at the three metrics: the price to earnings ratio, less than the S&P 500, the dividend payout ratio, less than 60%, dividend growth, to see a history of growing your passive income stream, and how fast have they been able to grow that income stream. We'll look at the dividend yield, and then we'll quickly see how they compare to their other friends, Dollar Tree, which is ticker symbol DLTR, and Big Lots, ticker symbol BIG, which it's funny because their market cap's only 217 million, which is very small compared to everybody else on this discussion.
Yeah, well, there's a reason why that market cap is small, and we'll get to that too after we get Dollar General through. So let's do Dollar General first, and then we'll show the other two comparable metrics from there. So the S&P 500 is trading around 20 to 21x on any given day. It's kind of all over the place.
I think it's like up to even 24. I don't know the last time.
Is it really?
Yeah, I think it's around 24 times
wow.
earnings.
See, it's growing. That's kind of, I mean, that's incredible. S&P 500 though continues to climb despite what's going on. So Dollar General's price is 157.11. Earnings per share forward is 10.13. Gives you a PE ratio of 15.5. So they are
not too bad.
No, it's trading at a discount compared to the S&P 500. When we look ahead to that payout ratio, their annual dividend is 236. It gives you a payout ratio of 23%. So a very, very low payout ratio.
Yeah, low payout ratio. And guys, the benefit of that, again, is that they'll be able to pay it. Earnings could be demolished here, especially with Dollar General's case. They'll still be able to pay your dividend and probably still be able to grow their dividend. Again, which is a good segue into that dividend growth streak. So guys, DG has been growing dividends consecutively for 5 years, which means they were able to do it during the global pandemic and currently during the most recent 2-year not going to call it a recession. And, they've been doing it at a pretty fast clip at about 15.92%. Now, I do have to leave a little caveat here because back in March this year, they increased their dividend and it was only 7.3%, which to me is actually still really strong, though it wasn't quite the 31% last year in 2022. But a 7.3% dividend increase in 2023, while the stock has been getting rock bottom, people's elbowed, jabroni driven down to the mat, is not that bad.
No, especially when you compare it to your other consumer staples like a Procter & Gamble, all the other ones that are just doing 2-3% increases. Dollar General still mustering a 7% increase in a tough year. That's fantastic. Their yield, though. So now that the stock is down 36%, their yield is up to 1.5%. So it's climbing. It's climbing. You look like you want to say something, Lanny. You have something you want to mention.
No, to piggyback, it's climbing because their 5-year yield on average is 0.9%.
Yeah, so it's incredible. That's what 50% plus from their 5-year average yield. So it's very much higher. So you look at it compared to the S&P 500. Sure, the yield's in line with the market, but compared to where Dollar General historically is, that's great. That's beautiful.
It's quacktastic, guys.
Yeah.
Now, go ahead, Bert.
Yeah, no, I was just gonna say I can just summarize the metrics and then we'll get into the comparables. That's kind of where the shock and awe factor for this analysis really comes in. PE ratio is 15.5, payout ratio is 23%, 5-year dividend growth rate is 15.92%. They've increased for 5 years with a 1.5% yield.
And I'm pretty sure Dollar General does something on Saturdays too for all your consumers out there. I think it's if you spend 25, you get 5 off or something like that. I know Family Dollar also does a certain promotion as well. So that's where the two really compete to drive foot traffic into the store. Just want to kind of put that out there to see if you viewers are aware. Let us know in the comments if you guys do that.
Well, that's an excellent segue. Let's talk Dollar Tree. Let's talk Dollar Tree, Family Dollar. Let's run them through the same metrics there before we get into Big Lots. Dollar Tree's price is 131.29. Their forward EPS is 604. PE ratio is 21.74. So they are trading at a premium to Dollar General, whose PE ratio was 15.51. But Lanny, what was the interesting thing about the company's dividend, which just throws this comparison into chaos?
Guys, this battle or discussion's over here because Dollar Tree does not pay a dividend. So dividend investors, I don't want to hear that you own Dollar Tree.
Yeah, yeah, and that's the most fascinating thing. Dollar Tree does not pay a dividend, but they are performing much better than Dollar General this year, though. When you skip past all those other metrics that are dividend based, they're only down 6.4% year to date. And over the last 52 weeks, they are down 18.93%. So doesn't pay a dividend, but the performance is less worse than Dollar General, is probably how I would describe it.
Less worse, guys. Well, enough with Dollar Tree. Let's look at Big Lots. Ticker symbol big. And big is big losses right now.
Yeah, big, huge losses, down 49% year to date, down 69% year to date. They just have been plummeted. They just actually missed earnings, missed sales. They are just getting, their results are awful. They were so bad that they actually suspended their dividend. So Big Lots, that dividend is big gone because it isn't there anymore. They're trying to plug that cash flow hole very bad. So the reason why we included them in there, despite the fact that they are not a true comparison to Dollar General or Dollar Tree, they are one of the other players in the value sector. It's just another example of a value stock, a value price stock that is just getting demolished. It is a tough, tough world out there for these.
You know, I remember when they came out with their dividend less than 10 years ago, and that was a big deal for Big Lots. And, you know, let us know in the comments if you own Big Lots. We apologize on, you know, the blow you just got dealt with a suspension of their dividend. Hopefully it's temporary. Hopefully they get things straightened out.
Yeah, and that's why their market cap is only 217 million, because they've lost so much value over the last year. It's terrible. Like, it sucks.
You
Uh,
know, so we'll put up the summary here of
yeah.
all three. You know, again, Dollar General's metrics. You know, if you're looking at it from a pure metrics and you wanted to get into this dollar store frenzy, Dollar General is not that bad of a stock just because of the valuation, right, Bert, and the yield that they're currently trading at.
Yeah, it's the one dividend stock in the sector. I mean, it's the one play you really have from the dividend standpoint. But quite frankly, I'm just going to avoid this sector altogether. It's clear the results are volatile, and what Dollar General is missing from becoming a stock that I want to even put on my watch list or even consider at the valuation is the fact they're missing the diversification that you get a benefit from if you're a Target shareholder or a Walmart shareholder, where you have enough other sales, enough other products, enough other categories to offset losses in one sector. Dollar General doesn't have that. So for me, this is just a pass on a sector altogether. That's why I was so shocked going into this analysis.
Guys, let us know in the comments if you've kind of seen Dollar General on your radar, if you've been itching to buy or if you've been buying Dollar General, or like Bert, are you avoiding the industry altogether here on this channel?
If you haven't already, subscribe to the channel. Give this video a big old fashioned thumbs up. And remember, if you're not with us, you're against us.
That was Bert and Lanny from the Dividend Diplomats, over and out.